Hello, everyone. My guest today is Patrick Campbell. He's the CEO of ProfitWell, the software for helping subscription companies with their monetization and retention strategies. ProfitWell also provides free, absolutely accurate subscription financial metrics for over 8,000 companies. Prior to Price Intelligently, which is obviously part of ProfitWell and what Patrick's building, he led strategic initiatives for Boston-based Gemvara and was an economist at Google in the U.S. intelligence community. Patrick, are you ready to take us to the top?
Let's do it.
Okay, so first off, establish the relationship between ProfitWell and Price Intelligently and how they feed each other.
Yeah, definitely. So Price Intelligently started, that was the first company, the first product, software product that was focused on measuring willingness to pay and value. So basically helping people with their pricing. We quickly pivoted into a tech-enabled service, which basically means you can't buy our software without our people and you can't buy our people without our software. And then about 3 years ago, we were sitting with a company that was about to IPO, helping them with their pricing. And essentially, we found out their MRR was completely calculated incorrectly. And so we started ProfitWell because we wanted a little bit more of a scalable software product that was cheaper, or in this case, free. And so essentially what's happened is we have a number of different paid products. And so the ProfitWell brand, we're changing our name to ProfitWell overall in the next couple of months so that, because it's a little bit more all-encompassing for the different things that we do in the subscription economy.
Now, how do you manage, we talked technically pre-call about this, obviously margins between SaaS and a high-touch human product are very different. Two questions there. One, how do you manage margins on both outlets? And two, how do you manage your time focused on kind of professional services versus pure play, low touch SaaS software?
Yeah, totally. So on the margin front, our margins are actually SaaS style margins on the ProServe side. And the reason that we get that is because we're not selling like a traditional service. Like it's not like you go into HubSpot and you ask for some training and they'll give you some training for 40% margin or something like that. We're actually selling it as a product and as the team comes with the product, if you will. And that just comes down to good pricing, which is basically we have really, really good pricing, which allows us to go after really, really high ARPU as well as really, really good automation to make sure that our margin are in the 90% range, similar to a regular software product. From like a team management perspective, this just comes down to hiring, the right people. And so for a long time, we basically managed both products kind of separately. So we had almost like a Price Intelligently team, and then we had a ProfitWell team. Now those teams are starting to blend together, but we still have essentially a GM of Price Intelligently where he runs both the sales side for that product as well as the actual fulfillment with the tech-enabled services team.
Got it. And you're able to keep kind of the margins high on there because it's supported by software. So you make the humans smarter with the software.
Yeah, exactly. And it's not custom. So it's not like you can come to us and like if you were going to McKinsey or something like that and say, hey, help us with this custom thing. We have a very like clear playbook that our software kind of writhes into, which then allows us to make sure that we're not, not eating at that margin with like, oh, we're going to do this whole other project that's going to cost us, another 10, 20 hours, things like that.
I want to dive more into ProfitWell as a company itself, but I'm also just interested in the data set that you get to see on a daily basis. What's the number one mistake you would say, SaaS entrepreneurs are making when it comes to pricing?
Number one mistake, and this is a real tactical one, because I don't want to say like focusing on the customer because that's true, but it's not tactical enough.
That's too fluffy for me. You know that.
I know. So I would say not using a value metric. So a value metric is what you charge for per user. You reference Halligan a lot, on this particular point, and I think that you need to be charging based on where the value is ascribed in your product. So per seat, per contacts, per amount of data enriched, per et cetera, because it bakes in expansion revenue into your actual business model, so that even if you're not really that good at customer success, you're not good at sales, you're not good at pricing, you at least have this lever that's automatically expanding revenue within your business to get to some beautiful net negative churn. So that's the big thing on pricing, I would say, from a tactical standpoint.
Most of these companies that have broken into the 50, 60, 70, or 100 million plus ARR range have nailed net negative churn. And it always comes down to they don't just have one or two utility-based pricing axes, but they have 3, 4, 5, 6, 7, even more sometimes. Is there any point at which the complexity of that actually decreases your ability to drive sales or just pricing communication in general?
Totally. It's a function, the complexity, you can get more complex the deeper your sales process is, less complex, the more touchless your sales process is. So when you're selling a HubSpot, for instance, which has on the low end, it has contacts, features, users, and a couple other factors. They have a whole sales team. You can't buy HubSpot without talking to a salesperson who can very easily tailor that pricing to you and then very easily kind of explain anything that's, walking through. Whereas you go to a Bitbucket, which is even a dev product, or a GitHub, GitHub, which is a dev product. They've kept it very simple with per user. I think both of them now, GitHub used to do per repos. But it's one of those things where if you don't have a sales process, you have to make it a lot simpler. So that's typically the thing that kind of is the function. And it's also your buyer. So a dev-focused buyer, if you've ever tried to buy AWS, it's super complicated. A dev buyer is going to go in, look at every toggle, and basically is comfortable with that. You're going to sell to a marketer or a salesperson, like the average marketer or a salesperson. They're not going to have the patience to go through all of those things because their job is just different and their thinking is just a little bit different. So I would say there's not really a heuristic I can give you. It's really dependent on what your sales and acquisition process looks like, as well as who the actual buyer is or the technical aptitude of the buyer.
ProfitWell, what's your utility-based pricing kind of axis that you price around, and what's the average customer pay you per month?
Yeah, so ProfitWell is free. The metrics, the baseline metrics are free. So you plug in Stripe, Zora, whatever you're using, and you get free access. And I can get into why we gave it away for free, but we have a number of products that sit on top of it, including Price Intelligently. So Price Intelligently, it's value-based pricing based on the size of our customer, as well as the scope of what they want us to help with on the pricing side. So it's a little bit of features as well as their size. We have a product called Retain that solves your churn. That value metric's the purest value metric can get. It's based on cash that we recover for you. So if we don't make you money, you don't pay anything. If we make you a lot of money, you pay us a lot of money, but it's not as much as we made you. And then we have a ProfitWell recognized product, which is an accounting product that basically is priced based on the size of the company as well. So that's kind of the utility. But if you'll notice, like all of those are different value metrics that as they grow, we're also going to grow in our revenue theoretically.
Yep. So if I forced you an average, I mean, are people paying you like $10 a month, $1,000 a month?
Sorry.
Yeah, it's okay.
So we focus on, we do have a long tail of people paying us like $50, $100, that type of thing. Our focus is on $2,000 a month, essentially.
Got it.
That's kind of like our target ARPU. We probably can be a little bit lax with that. We're bootstrapped, haven't taken any money. And so our mindset is a little screwed up in terms of unit economics, where we want things to be really, really high leverage.
Why do you put that so negative? I don't see that as messed up. I see it as much smarter than someone who's raised capital.
Yeah, well, our LTV to CAC is like 20 to 1. So it's like one of those things where if I saw that and I was giving someone advice, I would say like, hey, you can spend more money on acquiring customers right now, especially given some of the other problems in our business. And so I don't say it negatively like I'm embarrassed. It's more like I am embarrassed from a like optimization efficiency perspective. So yeah, we target, we really go after like people who are paying us 4-figure MRR. And I think our actual average is probably between 1 and 2, not quite at 2.
Got it. 1 in 2,000. And you mentioned LTV to CAC is 20 to 1. What are you spending right now on CAC, would you say?
Like, it's just people right now. We don't spend, like, we literally just hired our first marketing person like a couple months ago. Mm-hmm. We had some outsourced spending. So if I had to actually quantify it, it was probably around $10K a month, but that was for people. Yep. We were spending $0 on anything paid.
Yep. So you probably don't care much about this just because of the nature of how profitably you're running the company. But I mean, do you look at a fully weighted CAC, just take all your head count and divide by new customers that month? Or does that number not mean a lot to you?
We do it. We don't do it as like a active exercise, if that makes sense. So it's not like I could literally pull that number for each month for the past year, but we do look at it just in terms of making sure that, I should say that we're looking at it more and more because we're going to start spending more money and basically investing more in marketing. So, we do have very basic LTV to CAC by channel right now. We have very, very basic, I call it fragmented CAC, meaning like someone who talked to a salesperson versus someone who did this, just kind of seeing like the different processes through what they went through. But it's not quite something that we are like, it's reported every single month quite yet. Probably in the next 3 to 6 months, we'll have scary numbers that, we can break down to any nth degree we would like.
Let me give you a different question, but same kind of economics. Sure. How quickly do you like to recover any money you spend on acquisition? In other words, what payback period do you like to optimize for?
Yeah, it's really tough because right now the payback period is like, it's pretty quick. I mean, given 20 to 1, like it's basically one of those things. Like,
you think you get in the first month, like a month or 2 months?
Yeah, we basically get 1 to 2 months recovery. I mean, there are definitely customers that we don't get that because they're paying us $50 and they're on the low end and they were a little bit more touchless. Sure. But for like the target customer we're going after, like our payback period is typically in month 1. Yep. Especially in the Price Intelligently side. So our ARPU over there is probably around 150,000 per year. So it's one of those things where we just kind of get that going right through the door.
Because those are consulting gigs really powered by tech.
Yep, exactly. The tech-enabled service. That's what we call it. Yeah.
Well, even in worst case scenario where it is 2 months payback, if you're trying to get 4-figure ARPU clients, I mean, that's $1,000 a month. If your payback and your LTV to CAC is what you said earlier, it's like, $2,000 on CAC fully weighted and, $40K in LTV, the numbers check out totally. What's your team size to date?
So I believe we just crossed number 38 started today.
Okay.
And they're mostly based in Boston. And then we have a team of 6 folks in Rosario, Argentina.
Got it. I love it when I interview someone who has listened to other shows because you I'm going to ask.
I know what you're going.
I'm going to ask where you're from. Yeah.
I'm going.
It's great.
Yeah.
And when was launch year?
Let's get this going.
When was year one?
Year one. So it was the middle of 2012. So our first official year was 2013, but we had it was just me in a room for 6 months for 2012.
And where were you at that moment? I mean, did you have a bunch of saving? I mean, did you have an exit before this, or where was your head at?
I made the naive or lucky mistake. I cashed in my Google 401k. I was only there a year and a half.
How old were you then?
Huge. I was 24, 25.
Okay.
And I come from a blue collar family. So my dad, when I left Google, I worked at another company for just under a year. He was like, what in God's name are you doing? And then when I was like, I'm going to start this thing, he's like, you're insane. Do we need to have an intervention? And so thankfully it all worked out so far, but yeah, that's kind of what it was like.
And then what are you up to now in terms of total customers?
So it's a little bit hard because I actually don't know the count on retain versus on the PI side. I can just give you total ARR if that makes sense.
You mean the price intelligently side?
Yeah, the price intelligently side. So I mean, historically we've had about, I believe it was just under 500 customers. The ARPU has been going up, so it's not like we had that same ARPU early on, or else we would all be printing phenomenal amounts of cash. But our latest public numbers around size is 8 million in terms of ARR.
Yeah.
And so it's been good. I think for us, we've invested a lot of the profit into building ProfitWell. We didn't know it was going to be a free product out of the gate. And soon it was a free. We had essentially 2 years before we were monetizing it. So it's one of those things where the bet's paying off at this point. We have about 8,000, as you mentioned, companies using ProfitWell right now, which we're pretty pumped about. Yeah.
And if you're trying to target an ARPU of $2,000 and you said you're at least, maybe $1,000 and $2,000 now, I mean, divide that into the 8 million run rate, you're somewhere around 600, 700, 750 customers, something like that.
Yeah, that's a blend of both ProfitWell and PI, so it's probably lower, but it is one of those things. Yeah, totally.
What is as a bootstrapped company? I'm hoping you're going to give me a great growth number here, just to give an example that you can grow and be bootstrapped. What was December 2016 ARR run rate?
So about
13 months ago.
3.6.
That's great growth. That's almost 2x. Yeah. That's more than 2x year over year.
We have doubled or more than doubled every year. I think first 6 months we closed, that was in 2012, June to December. I think it was 126,000.
What do you mean by that?
126,000. That was our bookings in 2012. And then the first full year, 2013, we closed, I think it was 468,000. And then basically closed the distance now till then.
Yep. So December 2016 at about 2.6 million in ARR run rate, and then
3.6.
3.6. Sorry, that was my fault. Yeah. And now December 17 around 8. That's really healthy growth. How have you resisted the urge? I'm sure you're getting flooded with inbound, inside venture, all these people going, let us give you money. How have you resisted the urge, and would you ever accept and take capital to drive the business?
Yeah, for us, it's you know how it is. I mean, you buy companies and you sell companies, you know how the game is. It's a function, it's a tool, right? That's what equity and capital is. And so for us, whether it's through stupidity or intelligence, we don't have a very clear reason of what we would do with that money. So I couldn't tell you right now, hey, if we had $3 million right now that we raised or $8 million that we raised, here's exactly what we would do with it. And for us, if we don't have that reason in particular, it just doesn't make sense to raise it. So that's kind of how we look at it. I think we may raise money at some point. We're not really interested in taking any money off the table right now. We're not really interested.
Who's we, Patrick?
So it's me right now. I mean, I was the core founder. I had 2 part-time co-founders who were more advisors, and they're still part of our board.
I was going to say, that's an oxymoron. You can't be a part-time founder. You're either all in or all out.
there's a longer like fun story there. It's a good chapter in a book one day. But so essentially, the major stakeholders are myself, our CPO, our GM of PI, and then everyone at the company has equity as well. And so I mean, it's not as much obviously as the founder and things like that. But no one's like itching to get out, if that makes sense. And so we're not really interested in raising. I mean, in the next 6 months, as we figure out and really step on our growth levers and figure out a lot of the questions that you were asking before around here's our CAC here, here's our CAC here, and we know that might start to incentivize like, hey, raising. If we had an extra couple million, like let's just dump it on there because our market, I don't think it's winner take all, but I do think it's winner take most in certain places. And so, it is a little bit of a race, if you will.
Mm-hmm. Churn is obviously critical in most of these things. Now imagine because of the nature of your utility metric, if people are paying you, they're making more money than what they're paying you. So churn should be like abysmally low. What's your churn at?
It's very low. It's I think it was less than 1% last year.
Gross logo?
Yeah. So I mean logo, so it's a little bit different. I mean, I think logo churn was less than that. So for the year. So like logo churn might have been like half, like I would say I couldn't even tell you like 0.1% based on the money. I think we had one person leave because they switched to a billing system that we didn't support, but we just basically weren't gonna prioritize it. And so that was the only time that we lived. And we had a couple people, they just went out of business. And so, we couldn't really control that.
And are you at net negative revenue churn?
We are right now. We probably could be much better than we are. We're not really defending a lot of expansion right now. Okay. I know that's a little bit but we just started charging like 7, 8 months ago for retain. So it's one of those things where we've been a little bit like cautious because we're more focused on kind of the acquisition side, which I know is a little oxymoronic given some of the things that we publish. But it's just one of those things that we're focused on. And we're just probably going to start defending some of those upsells probably in the next couple of months.
Yep. You mentioned you just launched Retain. Where we talked about you're right now doing about 8 million in ARR. Where is the majority of your revenue? Which product is it coming through currently?
The majority of it is coming through Price Intelligently still.
Got it.
This year, the major goal is to basically change that proportion. So it's interesting because
what's the split? Can you give us the split real quick?
Right now, the split, I'm trying to do the math in my head. It's probably about 2/3, 1/3.
Okay.
That's kind of how we looked at it. But the funny thing is, and this is why you mentioned, or this sparked out of you mentioning the VC route. So the big goal last year was changing all of our revenue to subscription. So we didn't always have that even with the PI side. So right now about 85% of our revenue is subscription. And now the big goal this year is to basically change that proportion, to be maybe not 50-50, but to get closer to basically having multiple product lines that are, basically cranking in terms of, subscription revenue.
I don't think I followed that. You said currently 85% is subscription based and you want to get that down to more even 50-50?
No, sorry. Yeah, that was my fault. Essentially, before last year, a lot of that PI revenue that was coming in which is the
agency. It's the agency kind of. Yep.
Exactly. So the big goal this year was we wanted to get 75% or more of our revenue to be subscription so that when we go, if we wanted to raise, it looks, much nicer and all that type of stuff. And it also, like if we wanted to sell the company, it also looks a lot better. And so we changed that and we hit the last quarter of this year, we were at 85% of our revenue being subscription. So we hit that goal. And what I was mentioning is this year, the big goal is to change the proportion of our revenue, which was what you were asking. So making sure that PI or the Price Intelligently side isn't, 2/3 of our revenue, but it's more like half, if that makes sense.
Yep. Makes good sense. How do you beat companies like Baremetrics?
So, we haven't really been worried about them as much anymore, because I think we're definitely like on parity with them. I think our big thing has been accuracy. So we found out early on that if the numbers are accurate, people are going to stay with us. And so what we've done is we've spent a ton of time in being the number one, in terms of accuracy. And now it's just getting more and more features. And so we're ahead of them in terms of the amount of like dev resources that we have. And so what's started to come about is basically we're starting to release a lot of features that we're starting to see more churn from them and more people to come to us, including, ChartMogul as well, which is another, big company in the space. So I think we're thankfully, whether it's arrogant or not, we're thinking about like, how do we disrupt Looker? Like, that's what we're thinking about. Like, where does that go? Especially with a free product, like how do we develop that? And that's not going to happen in the next 6 months. It's going to happen in the next couple of years, essentially.
I just had those guys on. Did you hear that interview by chance?
I didn't listen to that one. No,
I'll link you to it.
I should have. Yeah,
no,
yeah.
Frank and what they're doing. I mean, I'm pulling it up right now. He said they're on track to break 100 million next year. It's all BI. It's all BI.
Yeah.
I mean, the interesting thing about what you have though that nobody else really has. Well, first off, there's two other companies you mentioned, ChartMogul, and the other one that's escaping me. But the ScaleWorks guys are obviously close to both of those companies. Would you ever pursue acquisition of those companies to grow your user base quicker?
Yep, absolutely. So we're going to be announcing this. Here's a scoop for you, Nathan.
Yeah, I love scoops. Give it to me.
Yeah. Not either of those companies, but we are buying another person in the space. The deal's closed, and we're going to announce it within the next month or so. So the thing is with this space, a lot of people don't realize there's less than 40,000 subscription companies in the entire world. It's not a lot. And that includes media companies, box of the month, SaaS, everything. And so for us to be successful, we know that we need to, one, sell into a lot of those, and then also make sure that we're selling multiple products. And so the verticalized nature of our analytics gives us an advantage to, a looker who's doing more broad-based BI, but because they don't want to get into that market yet, at least. But it also gives us a disadvantage because, the more ChartMoguls or the more barometrics that exist in the world, obviously it's something that's kind of diminished like our value. We need those users. And that's why free has been really helpful for us.
Yep. Let's wrap up here, Patrick, with the famous 5. Number 1, what's your favorite business book?
High Output Management.
Number 2, is there a CEO you're following or studying right now?
So I know everyone mentions Bezos, and I'm also there, but I think for what we're trying to do this year on our marketing side, I've been studying a lot of Bloomberg.
Yep. Number 3, besides your own, what's your favorite online tool?
Mixmax. I don't know if you heard of this, but I think just the calendar scheduling is just really, really good with that product, and we've been using it for a while.
Number 4, how many hours of sleep do you get every night?
Not enough, about 6.
Okay. And what's your situation, Patrick? Married, single, you have kids?
I'm not married, but probably soon to be, if you will. We'll see if she watches the podcast or listens to it.
There are 2 scoops, an acquisition and an engagement. We're gonna have Latka babies soon. I love it.
There you go. There you go.
Exactly. So not married, no kids, right?
No kids. I have a dog. She's a year and a half, so it doesn't count.
And how old are you, Patrick?
30.
30 years old. All right. Last question. Take us back 10 years. What do you wish your 20-year-old self knew?
Oh crap. How many things? To take better care of yourself. I've gained 100 pounds through this business. So it's been one of those things, and it's not the business's fault. It's definitely my fault, but it's been one of those things where I think I definitely sacrificed the body a little bit too much in growing the company.
There you guys have it from Patrick. Make sure you're taking care of your body as you're growing your company. He's doing it, in my opinion, the right way. Bootstrapped company, founded back in 2012, went all in, cash in the 401k. Now his team of 38 at ProfitWell and Price Intelligently are helping people make smarter decisions about how to price their products and how to retain more of the revenue they've worked so hard to get with their new retention product. They're focused on shifting more of their revenue to a pure play SaaS model this year, but they're well up over an $8 million annual run rate today, up from $3.6 million just 12 or 13 months ago, back in December of 2016. Again, totally bootstrapped, super healthy economics based up there between Boston and Argentina. Patrick, thank you for taking us to the top.